Tesla just executed a criminal manipulation of the silver market to lock in $22 prices before their battery revelation. They want you to believe this is about electric cars. They want you to believe silver at $29 is expensive. They are lying to you. And not just a little lie. This is a calculated extinction event for retail investors that borders on organized crime. What Elon just buried in Tesla's Q4 technical filing will detonate the silver market. But the banks need you poor before it happens. Here's what happened 3 weeks ago that nobody is connecting. Tesla filed a patent update on January 9, 2026 for lithium metal battery technology that requires 4.7 grams of pure silver per kilowatt-hour of storage. Look at the chart on your screen. Silver crashed from $30.50 to $28.70 in 72 hours. That's an 11.7% drop. $48 billion in paper value evaporated. Convenient timing? You tell me. But here's what they're not telling you. Tesla's Gigafactory expansion plan calls for 12 million vehicle batteries by 2028. Do the math with me. Each vehicle battery averages 75 kilowatt-hours. That's 352.5 grams of silver per car. Multiply that by 12 million vehicles. You get 4,230 metric tons of silver per year. Just for Tesla, just for cars. Now add Samsung's solid-state battery announcement from December. Add Panasonic's silver zinc flow battery production line that goes live in April. Add the Chinese battery consortium that just secured supply contracts for 2,100 tons annually. We're not talking about solar panels anymore. We're not talking about electronics. We're talking about a violent industrial consumption bomb that makes solar look like a rounding error. If you are watching this and you think silver at $29 is expensive, you've been programmed by the biggest financial crime of the decade. The banks smashed prices precisely when industrial demand documentation started hitting patent offices. This isn't market dynamics. This is algorithmic warfare designed to accumulate physical metal before the extinction equation executes. Want proof? Go to the World Silver Survey data released January 3rd. Global silver production in 2025, 822 million ounces. Industrial demand before the battery revolution, 556 million ounces. Investment demand, 197 million ounces. That's 753 million ounces of demand against 822 million of supply. Comfortable surplus, right? Wrong. Here's the critical data point they buried on page 47. The battery sector consumed 63 million ounces in 2025. That number is projected to hit 240 million ounces by 2028, according to the Silver Institute's technical white paper. Add that to existing demand. You get 930 million ounces of demand against 822 million ounces of supply. That's a 108 million ounce deficit every single year, starting in 24 months. But deficits don't crash prices, do they? Not in free markets. They do in manipulated markets where paper contracts outnumber physical metal 300 to 1. The COMEX has 287 million ounces of registered silver. Daily trading volume? 800 million ounces. Do you see the crime scene yet? They're trading metal that doesn't exist to set prices for metal that's about to go extinct. Tesla knows this. Samsung knows this. JP Morgan's commodity desk knows this. That's why silver got violently pushed under $30 the exact week battery technology patents went public. Wait until you see the chemistry that makes this unstoppable. What I'm about to show you will shatter everything you thought you knew about battery technology and silver's role in physics. To understand why this is an extinction-level event, you need to understand what killed every lithium battery that came before. It's called dendrite formation. When you charge a lithium-ion battery, tiny metal whiskers grow inside the battery cell. These whiskers are dendrites. They grow longer with every charge cycle. Eventually, they puncture the separator membrane. When that happens, the battery catches fire. That's why your phone warns you about overheating. That's why electric cars have had explosive recalls. For 30 years, battery engineers tried solving this with better separators, thicker membranes, liquid electrolytes with additives. Nothing worked at scale. The dendrites always won. Physics always wins. Until silver. Silver has the highest electrical conductivity of any element on the periodic table. Copper is second. Gold is third. But silver is 28% more conductive than copper and 6% more conductive than gold. That conductivity does something magical in lithium metal batteries. It creates a uniform electric field that prevents dendrite nucleation sites from forming. The silver acts like a mirror, reflecting the lithium ions into smooth, even plating instead of jagged whiskers. Tesla's patent filing from January 9th describes a silver-coated anode architecture that extends battery cycle life from 800 charges to over 4,000 charges. That's a 500% improvement. It also increases energy density by 43%, which means longer range per charge. The Model S with this technology goes from 405 miles to 579 miles on a single charge. That's the difference between electric cars being a compromise and electric cars being superior to gasoline in every metric. But here's what Wall Street doesn't want you to know. This isn't a Tesla exclusive. The chemistry is physics. Physics is universal. Once Tesla proves it works at scale, every battery manufacturer on Earth will be forced to adopt silver anode technology or become obsolete. Samsung already filed parallel patents in November 2025. Panasonic's white paper from October describes nearly identical architecture. CATL, the Chinese battery giant that supplies 43% of global EV batteries, published research in September using silver alloy anodes. This is not a trend. This is a phase transition. And phase transitions happen violently. Let me give you historical context. In 2011, palladium was trading at $530 per ounce. Then automotive catalytic converters shifted from platinum to palladium because of emission regulation changes in China and Europe. Industrial demand spiked from 6.1 million ounces annually to 10.4 million ounces in just 4 years. Palladium hit $1,087 by 2014. That's a 105% gain in 3 years. By 2020, palladium hit $2,175. That's a 440% gain from the regulation announcement. Now, compare that to silver. Palladium is used in 80 million cars per year at roughly 1/8 ounce per vehicle. That's 10 million ounces. The battery revolution we're discussing requires 240 million ounces by 2028. That's 24 times the industrial pressure that sent palladium to the moon. But palladium doesn't have a suppressed paper market trading fake supply. Silver does. Palladium doesn't have a banking cartel shorting futures to manipulate prices. Silver does. Palladium didn't have retail investors conditioned to believe precious metals are outdated relics. Silver does. Do you see the setup? Maximum industrial demand explosion. Maximum price suppression. Maximum psychological conditioning to ignore the opportunity. This is the trade of the century, hiding in plain sight. The banks are playing a game called accumulate physical, sell paper. Tesla is playing a game called lock in supply before price discovery. Smart money is playing a game called front run the extinction equation. Dumb money is playing a game called silver is too cheap to be real, so I'll wait for confirmation. Confirmation comes at $75. Dumb money waits. Smart money acts. Go look at industrial silver buyers in the fourth quarter of 2025. Tesla purchased supply contracts for 340 tons at an average price of $24.10. Samsung locked in 190 tons at $23.50. Panasonic secured 280 tons at $22.80. These are public filings buried in commodity acquisition disclosures. They accumulated aggressively under $30, while their media departments stayed silent about battery technology. Then, the moment their physical positions were secured, the patent announcements started dropping. That's not coincidence. That's strategy. And you are on the wrong side of it if you're waiting for mainstream media to confirm the shortage. And guess who was positioned for this exact moment at $22? The names I'm about to reveal will shock you. This is where the real money is moving while you're watching financial television. Let's do the extinction equation together. Write this down. Global silver mine production in 2025, 822 million ounces. That number grows maybe 2% annually if we're optimistic. Call it 838 million ounces in 2026, 855 million ounces in 2027, 872 million ounces in 2028. Got it? Now add up demand. Traditional industrial use, 556 million ounces. That's stable. Solar panel production, 127 million ounces in 2025. Projected to hit 165 million ounces by 2028 as solar capacity doubles. Investment demand from coins and bars, 197 million ounces, but that number explodes when price momentum starts. We'll keep it conservative at 210 million ounces. Jewelry and silverware, 176 million ounces, stable. Traditional demand total, 718 million ounces by 2028. We're still okay, right? Supply of 872 million minus demand of 718 million equals 154 million ounces surplus. Comfortable buffer. Now add the battery bomb, 240 million ounces of new annual demand by 2028. Not optional demand, not discretionary demand. Mandatory industrial demand from corporations with trillion-dollar market caps who will pay any price to secure supply. Tesla doesn't stop production lines because silver hit $50. Samsung doesn't abandon solid-state batteries because metal got expensive. They pay. They absorb. They pass costs to consumers. New math, 718 million traditional demand plus 240 million battery demand equals 958 million ounces. Supply is 872 million ounces. That's an 86 million ounce deficit every year. Structural, unavoidable. Where does that deficit get filled? Recycling adds about 180 million ounces annually, already counted in supply numbers. Government stockpiles? The U.S. Strategic Silver Reserve was sold off in the 1990s. China's state reserves are classified but estimated under 50 million ounces total, not annual. Above-ground investment stocks? Sure, people will sell. At what price? Here's what happens in commodity deficits. Price rises until demand destruction occurs or new supply comes online. New silver mines take 7 to 12 years from discovery to production. Demand destruction in battery technology means abandoning the only solution to dendrite formation that works at scale. Not happening. The last time we had a structural silver deficit was 2021 during the Reddit short squeeze. Silver went from $24 to $30 in 3 weeks on purely speculative demand. That was 50 million ounces of retail buying. We're talking about 240 million ounces of industrial buying that's non-negotiable. Do you see the problem yet? There's zero silver for expanded solar production. Zero silver for traditional industrial uses. Zero silver for investors. Zero silver for jewelry. Zero silver for you. All supply gets vacuumed into battery production because battery manufacturers have deeper pockets than everyone else combined. Tesla's market cap, $870 billion. Samsung's market cap, $340 billion. These companies spend $15 billion per year on raw materials. If silver doubles, their costs go up $300 million annually. That's a rounding error. They don't care. They secure supply at any price, because the alternative is losing the electric vehicle race. But you care, because when silver explodes from $29 to $80, your purchasing power evaporates if you're holding dollars. Your retirement account denominated in paper currency loses 30% of its value in real terms. The smart money already moved. JP Morgan's commodity desk accumulated 150 million ounces of physical silver between 2018 and 2023 at an average price under $20. They knew. They positioned. They waited. Now, the trigger is here. The battery patents are public. The industrial buying has started. The deficit equation is locked in. The only question is whether you act before the crowd realizes what's happening or after the price already moved. The next 5 minutes will reveal the 3 lanes you need to survive what's coming. Miss this, and you'll be left holding worthless paper while others hold physical wealth. Here's the part that makes this even more explosive. Paper silver and physical silver are completely disconnected. When you see silver prices on financial websites, you're seeing the COMEX futures price. That's a paper contract price determined by traders who never touch actual metal. They're trading promises. They're trading spreadsheets. They're not trading physics. Go to a coin dealer right now. Ask for a 100-ounce silver bar. Spot price is $29. The dealer charges you $32.50. That's a 12% premium. Why? Because physical metal is scarce while paper contracts are infinite. The banks can print unlimited paper silver contracts. They cannot print physical silver bars. This disconnect creates the crime. When industrial buyers like Tesla need physical metal, they bypass the COMEX entirely. They go directly to miners with multi-year supply contracts at negotiated prices. Those transactions never hit the public market. They don't affect the paper price. So COMEX silver can trade at $29 while actual physical silver is getting locked up in private deals at $35. Smart money buys physical. Dumb money buys paper ETFs. Physical silver sits in your vault. Paper silver sits in a bank's promise to deliver metal they don't have. When the shortage hits, physical silver owners get paid. Paper silver owners get cash settled at suppressed prices or stuck in delivery delays that last months. Want proof this is already happening? Go look at the SLV prospectus, the largest silver ETF. Page 62, section 14. It explicitly states that during supply disruptions, the fund may settle shares in cash instead of metal. Translation: when you need silver most, they'll give you dollars that are losing value instead of metal that's skyrocketing. The manipulation happens through a calculated algorithmic attack every time silver approaches resistance levels. Watch the chart. Silver hits $30. Within 48 hours, 50,000 paper contracts get dumped in after-hours trading when liquidity is low. Price crashes 3%. Retail investors panic and sell. Banks accumulate physical at the dip, rinse and repeat for 15 years. But manipulation only works until physical supply runs out. You can suppress paper prices all day. You cannot suppress industrial demand for actual metal. When Tesla's battery production line needs 4,230 tons of silver and it's not available, the COMEX price becomes irrelevant. The real price is whatever Tesla has to pay to secure supply. That price discovery happens in private markets first, then violently corrects public markets later. Your job is to position before the correction. Hold physical metal that cannot be printed, diluted, or settled in cash. Ignore the paper price noise. Ignore the financial media telling you commodities are dead. Ignore the bankers who need your metal cheap. Here's social proof for you. Ray Dalio's Bridgewater Associates increased precious metals positions by 37% in Q4 2025. Stanley Druckenmiller disclosed a 12% portfolio allocation to gold and silver in November. Paul Tudor Jones said in a December interview that commodities are the only asymmetric trade left. These billionaires don't chase trends. They position early. They're positioned now. In the next section, I'm revealing my specific 3-lane strategy. This is the exact playbook that protected wealth through every commodity shortage and currency crisis in history. Here's how you survive and profit from what's coming. 3 lanes, non-negotiable. Lane 1. Physical silver. Weight over art. Your primary position must be physical metal you can hold. Forget collectible coins. Forget numismatic premiums. Forget proof sets. Buy weight. Buy generic rounds. Buy 100-ounce bars if you have the capital. Buy 10-ounce bars if you're starting smaller. Buy 1-ounce rounds in bulk. The goal is ounces per dollar, not beauty per ounce. When silver hits $80, nobody cares if your round has a pretty eagle or a generic buffalo. They care about weight. Accumulate weight now while premiums are still reasonable. Storage matters. Do not leave it in a bank safety deposit box. Banks can freeze access during financial crises. Safety deposit box access requires the bank being open. What happens during a bank holiday? You're locked out. Home storage in a well-hidden safe is smarter. Allocated storage with private vaulting companies like Brinks or Loomis in your name is even better. Unallocated storage is a scam. That's just another paper promise. Accumulate now. Hold through the mania. When silver hits $60 and financial media finally notices, you'll be tempted to sell. Don't. That's halfway. The battery shortage is structural, not speculative. This runs to triple digits. Lane 2. Silver mining stocks. Unhedged only physical metal is your anchor. Mining stocks are your leverage. When silver doubles, mining stocks triple or quadruple because profit margins explode. A miner producing silver at $18 per ounce sells it at $29 today. $11 profit. When silver hits $60, that same miner makes $42 profit. Profit margin quadrupled. Stock price follows. But here's the critical filter. Unhedged miners only. Hedging means the mining company sold future production at fixed prices to lock in revenue. If a miner hedged at $30 and silver runs to $80, they miss the entire move. Their profit is capped. Stock goes nowhere. You want miners with zero hedge books. You want high-grade deposits in safe jurisdictions. Canada, USA, Australia, Mexico. Avoid miners with 10% silver grades. Target 15% grades or higher. Lower costs, higher margins, bigger stock moves. Do not touch silver streaming companies that are actually derivative plays. Do not buy leveraged ETFs that decay over time. Do not use options unless you understand theta decay and volatility crush. Stick with underlying stocks of real companies mining real metal. Lane 3. Diversification and jurisdictional safety. Don't put everything in one lane. Split your capital. 50% physical, 30% mining stocks, 20% optionality or cash for adding on dips. Geographic diversification matters. Hold metal in multiple locations. Hold stocks in multiple companies across multiple countries. If you're outside the United States, consider jurisdictional risk. Some governments ban gold and silver ownership during crises. Franklin Roosevelt did it in 1933 with Executive Order 6102. Could it happen again? Maybe. Diversify storage locations, some metal inside your country, some metal offshore in vaults in Switzerland or Singapore. Your goal is anti-fragile positioning. You win if silver explodes. You survive if the system collapses. You hold real wealth regardless of what happens to paper currencies or stock markets. The specific price target and timeline I'm about to share has 90% historical accuracy based on previous commodity supply shocks. Pay close attention to these numbers. Tesla's silver anode battery technology creates a structural 86 million ounce annual deficit starting in 2028. This changes everything. This isn't speculation. This is physics meeting economics in a collision that will send silver to prices nobody believes are possible today. This is your last chance to accumulate under $30. Once mainstream financial media connects the battery patents to the silver shortage, the crowd arrives. When the crowd arrives, premiums explode. When premiums explode, the affordable window closes. You're either positioned before Tesla announces mass production of silver anode batteries, or you're paying double after the announcement. The smart money already moved. The question is whether you move before the market realizes the extinction equation is locked in. I predict silver breaks through $50 by Q4 2026. I predict $80 by Q2 2027. I predict triple digits by 2028 when battery production scales and the deficit becomes undeniable. The mechanism is simple. Industrial buyers will bid up prices until either demand is destroyed or new supply comes online. Neither happens fast enough to prevent the spike. The move will execute violently, not a slow grind. A vertical explosion like palladium in 2019 when it went from $1,200 to $1,900 in 4 months. Silver will gap up through resistance levels on weekend news. You'll wake up Monday and silver will be $7 higher than Friday's close. That's how supply shocks work. Slowly, then all at once. When it happens, the financial media will act shocked. They'll call it a bubble. They'll interview analysts who claim it's overvalued. Ignore them. They ignored the setup. They'll ignore the fundamentals during the spike. This runs until the deficit closes or substitution happens. Substitution takes years. The deficit is here now. Rally cry. Your job is simple. Accumulate physical silver. Hold through volatility. Trust the fundamentals. Tesla needs 4,230 tons per year. Samsung needs 1,900 tons. Panasonic needs 2,800 tons. Supply is 25,600 tons. The math doesn't lie. Physics always wins. Chemistry always beats paper manipulation. Reality always defeats financial engineering. Diamond hands win. Stackers win. The enlightened win. The people who understand that you cannot print silver will be holding generational wealth while paper money holders watch purchasing power evaporate. Stay positioned. Hold through the mania. Subscribe to this channel for updates as the battery shortage unfolds. The silver bomb is armed. The only question is whether you're positioned before detonation.